I never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now.
You know, I know you look at things like that, but I also know that you look at stocks and try to decide if they're fairly valued, if they're overvalued, if they're looking cheap at this point. And we have been waiting for a correction for an awfully long time.
Awfully long time.
That's finally come. Do stocks look cheaper to you, just based on where we've come?
Well, anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news, just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy. You know, stocks are going to go down. You could probably look it up as to what percent of the days, since I was born, they've gone down, and maybe it'd be 30% or something like that. And you can't predict what stocks will do in the short run. But you can predict that American business will do well over time. And just take the 20th century. Stocks went from 66, the Dow average, 66 to 11,497. And you were getting 3 times as much in dividends as the whole average was selling for at the start. And you had 2 world wars, and you had a Great Depression, flu epidemics, all kinds of things. American business will do fine over time.
Do fine over time.
And if you own a piece of it, and if you don't beat yourself, the only person that can cause you to get a bad result in stocks is yourself.
Yeah, unfortunately, that's the biggest problem, is trying to fight yourself in some of these situations.
Yeah.
Have you been buying more stocks lately just because prices have come down? Have you upped your percentages and other things just
We're
because?
almost always a buyer of stock. So we have bought more stocks since the end of the year. We earned 17 and a fraction billion last year, and we had our float go up $4 billion, which is additional money available. And so we're almost always a buyer of stocks. And we're a more aggressive buyer when they're going down. I mean, I feel much better when they're going down, but it's hard to think of very many months when we haven't been a net buyer of stocks.
It is not important to predict short-term market trends. He believes that stock prices will rise in the long term. He continues to buy more stocks and welcomes falling stock prices. This is because falling stock prices give investors more buying opportunities. He believes that American businesses will grow over time and urges that people should not be fooled by temporary market fluctuations. In fact, based on his investment philosophy, he actively buys more stocks when stock prices are falling. Let's take a different look at how Warren Buffett deals with a crashing market. Warren Buffett's crash philosophy: how to deal with market uncertainty. 1. Unpredictability of the market and intrinsic value. Buffett is based on the premise that short-term market trends are unpredictable. While warning in the 2022 Berkshire Annual Report that a crash of 50% or more is possible, he maintains the immutable standard of improving the profitability of U.S. companies. What is important is the assessment of intrinsic value, that is, can a company maintain its competitive advantage in 10 years' time? And he asserts the relative attractiveness of stocks in 2025. Comparing the S&P 500 earnings yield of 4.2% versus the 10-year bond yield of 3.8%. 2. The strategic meaning of holding cash. Buffett's $167 billion in cash strategy is not simply risk aversion, but is designed as a strategic preparation for liquidity. As in the case of maintaining $50 billion in purchasing capacity during the 2020 corona shock, the cash balance for the first quarter of 2025 from Berkshire Hathaway's financial statements is a preparation for when Mr. Market panics. However, by adhering to the rule of always having $15 minus $20 billion in cash liquidity, they are avoiding opportunity losses due to excessive cashing out. 3. Building a psychological advantage. The core of Buffett's response to a crash is the same psychology as consumers who are happy when hamburgers go down in price. He pointed out that the market's emotional overreaction is unrelated to business value. During the interest rate hike phase in 2022 to 2024, he will continue purchasing using the float of his insurance business, about $158 billion. In particular, the idea of viewing temporary impairment losses of blue-chip companies as a decrease in the cost of acquiring future cash flows is reflected in the case of the additional purchase of Charter Communications in 2024. 4. The importance of a historical perspective. Based on the fact that The Dow average in the 20th century went from 66 to 11,497 times, an increase of about 350,000% after dividend reinvestment. The crash is relativized as the self-correcting process of capitalism. The current financial environment in 2025 is evaluated as high corporate profitability compared to the 1973-74 stagflation period. The important thing is that investors themselves are the biggest enemy, suppressing overreaction. And this lesson has borne fruit in Berkshire's action of buying back $25.3 billion of its own shares in 2024 during a period of market instability.